Let's take a couple of minutes and look at what the journal entries might look like for sales and return transactions. So let's suppose Paul's Hardware sells merchandise on account, terms 110 net 60 for $700, and the cost of the inventory is $380 on March 17th, 2012. Paul's Hardware later received $235 of the goods that cost $105 as sales returns on March 21st, and then the customer paid the balance due on the 26th. Okay, so let's go ahead and get started. So on the, looks like 17th, we first need to record the sale, and you all have been doing this for a number of weeks now, so you should be pretty good at that. Instead of receiving cash, we sold the merchandise on account, so we will debit accounts receivable, which is an asset. And by debiting that receivable, we're going to increase our asset, $700, and we'll go ahead and credit our sales revenue. This is how we make our money. We sell merchandise. So our revenues are going to increase now by $700. Now there's something else with this particular transaction. They tell us what the cost of the inventory is. That way we know this is a perpetual inventory system, and we're going to have to go ahead and also take that inventory that we just sold out of our bookkeeping. So we will credit inventory, which will have the impact of decreasing our inventory at its cost, which is $380. And we're going to go ahead and debit cost of goods sold, which is exactly what it says, the cost of the merchandise that we sell, which is an expense. So we're going to increase our expenses for $380. So if we were going to go ahead and do a quick balance sheet right now, or I'm sorry, income statement to see where we stood, we would take our sales revenue of $700. You wouldn't normally have to do this. I just want to show you something. Minus our cost of goods sold of $380, and there's our gross profit right now. So gross profit on this particular sale is going to be $320. Now the company with that gross profit has $320 to go ahead and pay all of their other expenses. Let me go ahead and erase that. So it's really important information. Usually a higher gross profit is going to be better because then we have more money to pay all of our other expenses like rent, utility, salaries, etc. Okay, so then it says on the 21st that we received a return. So the customer, for whatever reason, returned some of that merchandise. So rather than just reversing this first journal entry and debiting sales revenue and crediting accounts receivable, we're going to debit an account called Sales Returns and Allowances. That's a contra asset account, and it's going to help us keep track of all the returns and allowances that we have coming back. And that will be for $235. And then we'll credit the customer's account. So I mentioned this in the last video when we were buying inventory, but when you take merchandise back to, say, Target or Walmart or wherever, and you paid for it with a credit card, they say, oh, I'm going to credit your account. Excuse me. Guess I shouldn't talk and write at the same time. That should say accounts receivable. They're going to say, oh, I'm going to credit your account. And now you know where that comes from. They really do credit your account on their financial statements. So we showed it as a receivable. Now by crediting that receivable, the monies that we had coming in, that reduces that amount. All right, we also have to put that inventory back on our shelf. So we debit inventory for what it costs, which had a cost of $105, it tells us. And we credit cost of goods sold. So we reverse the second part of that journal entry. Okay, that looks pretty good. That looks pretty good. Then the very last part here is the customer paid the balance due on March 26th. Well, let's see. We had terms of 110 net 60. So that was on March 17th. Is it in the 10-day window? Are they able to take advantage of the discount? And it appears it is. 26 minus 17 is only 9 days. So they are going to take the discount when they go ahead and pay us. And I'm going to flip to a clean slide here. No, I'll leave it open just so we can refer back to all this information. Alright, so this is now March 26th try and write small. And we're going to know we're going to debit cash because they're going to receive a check from them on the monies that they owe us. Well, let's take a quick look at what their account looks like right now. So their accounts receivable, we had a debit of $700, and then we had a credit of $235. So it looks like $465 is the balance right now in the accounts receivable. So we're going to have to take $465 minus the discount. Well, we don't know what that's going to be right now. So they are going to take advantage of that discount we just said. And that was for $465 times 1%, which is only $4.65. Going to go ahead and credit our accounts receivable then. Sorry about that. That was a little squeaky. My pen. Go ahead and credit the accounts receivable for $465. That was this balance that we have showing. Alright, $465 was the discount, so the amount of money that we're going to receive from our customer is $465 minus $4.65, which is $460.35. The hardest part of these problems is keeping track, especially when you have multiple people buying and multiple purchases coming in, which accounts are associated with whom. So make sure when you're doing your T accounts or you're coming to the end and you're figuring when someone pays it off or you need to pay it off, exactly to whom it is that which accounts those transactions belong to, so you can calculate this information accurately.